All right, Jenny, you want to get us rolling?
Yep, I'll do it. Again, thank you everyone for joining this webinar today. I'm Jenny Kane. I am the VP of Marketing, and we love this business expert series because we can bring in domain experts like Mike to come in and chat with you. And this is about the market, which everyone is very interested in right now. So Mike is the founder and president. I had to scratch out CEO since you're acquired by HW Media. He's the president of real estate analytics firm Altos Research. His firm has provided national and local real estate data to financial institutions, real estate professionals, and investors across the country for more than 15 years. I think that's about how long I've known Mike. He founded Altos Research in 2006 to bring data and insight on the U.S. housing market to those who need it most, and that's you all, the real estate agents. And he's an expert trend spotter. He uses Altos data to identify market shifts months before they hit the headlines. Mike's insight on the housing market have been featured in Forbes, New York Times, Bloomberg, Housing Wire, and The Atlantic, and many other national media outlets. I think you're going to get a lot of good information today, and I highly recommend that you follow Mike on Twitter and YouTube, where he posts weekly housing stats every Monday afternoonish, right, Mike?
Yep, that's right.
Okay, with that, well, let's let the experts speak. Take it away.
All right. Thanks, Jenny. So, hi everybody. I'm Mike Simonsen, and I'm the founder president of Altos Research. And at Altos, we track every week. We track every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional headlines. You know what we're doing now is it's mid-January. We've got a couple of weeks of January data under our belt, and we're looking for signals for what's happening this spring and really what can we see for all of 2023. There's some really fun signals in the data each year between the second and third week of January, second, third, fourth week. So like right now, next week, the next few weeks of data coming in. And what we'll look at today are, that there are a lot of anecdotes that we've been hearing from realtors across the country who in the last few weeks have been reporting surprisingly strong buyer demand, like traffic at open homes, multiple offers on houses, not of course frenzy, but compared to last fall, there's suddenly reports of more of buyer activity, like there's home buyers out there. And what we'll try to do today is look in the data. We see if we can confirm that, if those buyers are just kicking the tires or if they're actually buying. And we're going to look for a few different signals that way. As we go through the conversation today, I'm going to start with national data, a view of the across the country. And then I have some Altos reports at the local level, metro levels around the country. So we can compare and contrast how those the markets are behaving. In the chat, we have Lael from the Altos team. I will sometimes mention links or resources or something. And so use the chat box to look for those links. You can go click through and get those things that I refer to. You can also use it to ask questions, and Lael will answer them as best she can while I'm doing the talking. So we're going to start today with looking at mortgage rates. They spiked up super big and we saw real buyer slowdown. Then they've backed down a little bit. So we're going to take a look at the implications of mortgage rates now and for the year. We have a view of the active inventory now and what we can see, the curve that we can expect for inventory over the year. And as I mentioned, there's a handful of weeks in early January between the first and second, or the second and third and fourth weeks of January, where we can really start to see some of the leading indicators come in for the year in terms of inventory and pricing and transaction volume. We can see a bunch of those things. But really what I'm trying to do in this conversation is we have the data, and you have buyers and sellers out there in the market. And those buyers and sellers have opinions about the market. They very often right now have a really bearish opinion about what's happening in housing. The headlines that they're reading are home prices are down and transaction volume is down and buyer demand has evaporated, which of course, those things were happening in the fall. And so the headlines still reflect that. And so very often right now, you have buyers and sellers who are expecting a crash. They're expecting home prices to fall by a ton. And what we want to do is share the data, help them see what's actually happening, where it confirms their hypothesis and where it doesn't, like where the data is different from what they're assuming about the market. So what I'm going to try to do is when we look at each of the data pieces, help you frame how to use that in the conversation with your buyers and sellers at any time. And then in the second half of the conversation, we're going to dive into the local markets. We're going to use the Altos reports to look at a few of the different local markets. Some of the local markets are behaving very differently. Some slowed way down in the fall, but others didn't. Some have inventory climbed up to pre-pandemic levels. Some are still at the crisis low levels. So we're going to spend a little bit of time with the local markets. When we, as we go through the conversation, I'm talking about the data. If you want to learn about how to communicate about the data, how to use market data in your real estate business, we have a free ebook that we published at Altos Research. You can go, Lael will post the link to this in the chat, so you could just click through and grab it. But we talk about using scripts. We talk about how to answer what the data is saying, what it's not saying, how to frame the conversation with your clients. So I recommend that you go grab that ebook if you haven't already gotten the free ebook from Altos. It's how to use market data in your business, and it'll go right along with the conversation that we do today with the stats that we review today, and the stats that you get with your Altos, with an Altos subscription. By the way, we're going to talk national data today. Altos tracks every zip code in the country. And if I don't get to your local market today, go to altosresearch.com. And when you sign up for Altos, the first thing we're going to do is teach you how to read the data for your local market, how to talk about your local market with your buyers and sellers right now. And so if I don't get to yours, we have it for every zip in the country. So just go to Altos to get that. And I'll show you a little bit more about that later on. All right, let's start with mortgage rates. Current rate for the 30-year across the country right now is about 6.4%. You can see this rate curve over multiple years here. And at the far right end of the chart, that was 2022 when rates spiked way up. And the important observation here was there's this threshold at about 5.5%. When rates in the first week of September jumped from 5.5 to 6.5 to 7.5, that's when buyer demand stopped cold. Buyers were very, very sensitive to that big jump. And we could see it in things like inventory started climbing late October, which is very unusual. So we had buyers stopped so cold that anything on the market sat, and new things started piling up in late October when normally inventory would be declining. We could see price reductions spiking in October and November. But then in December, rates started coming back down, and we started seeing a little more loosening of that. The bright red at the far, that's the far left, right side of the chart. That's the first couple of weeks of January. A little lower, a little higher, right around 6 to 6.5%. During the year, if rates fall below 6 and start getting around this 5.5% threshold, that feels like, based on what we could see last summer and that transition the first week of September, that 5.5% feels like a threshold for affordability, meaning when rates are 5.5%, we're going to see buyers. We may see more buyers than expected by us or by any of the people in the industry. If rates drift lower, if they drift higher, and they drift to over 7, I think you're going to see things will have to revise down some of our expectations for the year. I think there's really a threshold there. And right now they're in the 6s, and we can start to hear the anecdotes about, wow, there's some buyers in the market. Interestingly, my friend Dan Green at homebuyer.com points out that there are programs in the market now for example, first-time home buyers. If you're a first-time home buyer and your income is less than the average for your metro market, you could actually get a federal program that discounts your mortgage rate by a point or point and a half to in the 5s or the 4s. So there are opportunities for first-time home buyers this year that haven't existed for several years. It's something to be to help your buyers and sellers be aware of, because as I said, everybody has this perception of the headlines that are probably a bit more bearish than they're actually acting right now, than the market is actually acting right now. Let's look at inventory. So available inventory of single family homes in the market right now is about 473,000. That ticked up just a fraction from last week. It's at the second week of January. Most years, inventory ticks up in the second or third week of January. In the last 2 years, you can see the last 2 Januaries, inventory kept falling during the pandemic. Rates were super low. We were buying everything in sight. And so available inventory kept falling into February, March, even April, before inventory started turning around. And so this year is much more normal in terms of starting to climb right now. And what's interesting is that 473,000, that's a lot more than last year at this time, more than in 2021, but still 36% fewer homes on the market right now than when we started 2020, before the pandemic. So we still have really few homes on the market in most places in the country. There are a few of the local markets that have more, that are back to their pre-pandemic levels, and I'll show you a few of those and what that means and which direction they're heading is really important. But the big thing to notice is that buyers right now have more selection than they have had in several years. They have less competition. And so they like the opportunities for buyers are starting to feel loosened up a little bit, especially if they were outbid last year in the crazy bidding wars. It was not a good time to be a buyer. You were fighting for everything. And this year, we have slightly more inventory. One thing to note here is there is nothing in the data that shows a big wave of inventory coming. So if you have a buyer who is sitting on the sidelines saying, I'm going to wait for a crash, I'm going to wait for the big flood, I'm going to wait for the prices to come way down, there's nothing in the data that shows that. What's showing right now is that we have significantly lighter demand than we've had in several years, but even less on the supply side. And so that's what is a factor. And I can show you that this way. So this is a chart of new listings each week, and each bar is a week, and the total number of new listings in a given week. The light part of the bar there are the new listings that went into contract essentially immediately. So if you remember, during the pandemic, the defining characteristic of the pandemic boom is what we call the immediate sales. Those are house got listed and then they took offers that afternoon and they closed on 2 days later, or those that like essentially spent zero time on the market. They got listed and then they went into contract essentially immediately. Last year at this time, there were 56,000 new listings, but 17,000 of those went into contract immediately. There were the bidding wars and the multiple offers and all of those things that happened essentially immediately after listing. As a result, there was, there were very few that were staying on the market. This year, at the far right end of the chart, this year, we could see fewer home new listings. So only 46,000 new listings. So fewer sellers than we had even last year this time. The difference is that only a handful of those are going into contract immediately. So the contract, the immediate sales being smaller is obviously the demand's later, but the sellers, fewer sellers, by like 20% fewer sellers now, because everybody in the country has their cheap mortgage. We are all employed, so nobody's worried about their job. Incomes are rising. So all of those factors, and when I say nobody's worried about their job, there are, as of right now, unemployment is still very low and incomes are still rising. And so there's no urgency for most sellers in the country. As a result, we have really low supply coming to market. And so for buyers who might be waiting, or for sellers who are afraid to list right now, I don't want to list now because I hear the market's really bad. What we can see is that you have significantly, as a seller, significantly less competition than you might imagine, and a few buyers coming in there. And on the buyer side, there's no sign of any surge in inventory. It's just normal seasonal patterns starting to happen. And that's really a different perspective than most of your buyers probably have. Like, most of your buyers are probably there, say, like, worried about the market. I hear the market's crashing. There must be people trying to sell their homes, but in the data shows us it's actually not true. And so then here's what happens to the inventory curve over the year. In this chart, each line here is a year of inventory. Inventory starts low, and in most years it starts ticking up in January, February. It then hits the peak of the curve in the late summer before declining into the fall and winter. What we can see right now is that the dotted line is a curve for what we might expect for 2023. Assuming rates stay in this 6.5% range, we can see that we're getting more inventory, and that 6.5% range does things like makes investment deals less profitable, and so they don't pencil out. So there's a few more listings that happen from investors. There are fewer buyers. So given a rate, say rates around 6.5%, you can see that we would get close to previous years. So 2017, 18, 19, normal amounts of inventory for the last half of the last decade was 800,000 to 1 million homes on the market, single family homes at any one time, 800,000 to 1 million. And as of right now, we have 473,000. So if rates stay there, we have things slow, sort of slow this year, then you can see how inventory will climb in April, May, June, July, August, and get us close to that, maybe 700,000 homes, single family homes. On the other hand, if rates drift lower, below 6 into the 5s, we will probably adjust this forecast down, because we'll have more transactions, we'll have more buyer demand, we'll have more things like investors who want to hold on to their properties in those kind of conditions. If rates drift higher than 7%, then you'll probably see this line shift up over the years. And what we do over the year, and what we do is each week we have new data, and so we adjust this forecast every week. And you can watch us do that in our weekly Altos videos that you can find on our YouTube channel. The big difference between this year and last year, inventory kept falling. January and February last year, rates were still 3% or lower. And so inventory kept falling all the way until March. In 2021, inventory kept falling all the way till the end of April. And so we get a little bit more climb of inventory now, get a little bit closer to normal for the year, but probably not back to normal. Again, this illustrates that, buyers have more selection than they've had in a few years, but there's no like flood. We're not going to have a million homes anytime soon. There's just no sellers in the mix that need to or want to unload their properties. So there's no signal for it anywhere. Even if you have folks in your sphere who are afraid or are convinced that that's going to happen, maybe it happens, but as of right now, there's no signals for any big wave of inventory anywhere in the data. On the other hand, we can look at the sales side, the demand side, by watching the pendings count. So, homes in contract right now, you can see we have 238,000 single family homes in contract in the pending stage. You can see each bar here is a week, and the light portion of the bar each week are the newly pending. So these are the ones that went into contract. And you can see that it's pretty striking since May of last year. Fewer and fewer sales dropped dramatically from last year. We have 34% fewer homes in contract right now than we did last year at this time. And you can also see fewer homes going into contract each week. We can see it happening. The important thing to take away here is that these pendings now were offers that happened in the fourth quarter, listings and offers that happened in the fourth quarter. They're now in contract. They maybe stay in contract for 30 or 60 days before they close. And then those headlines will start to be reported. So, houses on the market now, it goes pending in February. It maybe closes in March or April. You start hearing about that in April and May. And so headline wise, your clients, your sphere, your people are going to be hearing very bearish headlines for several more months. They're going to be hearing because the number of homes pending are super low. The number of sales are going to be super low. So the seasonally adjusted sales that come out in the headlines from NAR, for example, are going to be very low for the next several months. What we're going to watch for is watching this data each week and see how much it starts to climb before the headlines. And we'll be able to know, wow, like we know anecdotally, and I've heard, from agents around the country talking about like, wow, we have more buyers than we expected, than we've had in months. We have more people in the open home. We did multiple offers on a deal last week. I'm hearing these kind of anecdotes from across the country, which is really fascinating. And so what we'll know is when they show up in the pendings data, and how quickly does that weekly bar rise does it get us closer back to, like less frigid market conditions. But the key here is that we can already know that the headlines that your buyers and sellers are going to be reading are going to be really bearish for several more months, even if the leading indicators, the data we're talking about here, is bullish. So that's going to be a really important part of the conversation that you're having with your clients in the next few months. What we recommend is that you take your Altos report, you say, to the people, you say, like, I know you just read that home sales are way down, but I'm going to put this report in your inbox every Monday, and I'm going to show you the data every Monday. And I'll show you which data points to point out to them, and so that they can stay informed before they read the headlines. That'll be the technique. All right, let's talk about pricing. The median home price in the US right now for single family homes is $409,000. That's up 10% over last year at this time. And it's actually stronger than I expected to start the year. It's a little bit higher than we expected to start the year. It ticked up by about 1% this week. And it's not unusual for home prices to tick up in January because we have new inventory. We have the good inventory that's been held off over the holidays. Now we start to list it. But given the conditions of last third and fourth quarter, you could imagine a scenario where home prices kept ticking down a little bit longer this year. That didn't happen. And so when we list the homes for sale, this is, the collective wisdom of all the sellers, all the listing agents who know that there were offers on the place down the street, who know that what the comps were and how to price the new listing each week. And so this is an early signal that home prices are holding up across the country, that even though you're still going to, like I said, still hear the bearish headlines for several more months, we can see in the data that the buyers and the sellers are like settling in at not at like a reasonably solid pace, stronger than I expected to see in this part of January, to be honest. The light red line here is, these are the price of the new listings. So in any week, the new listings that get listed on the market, where are they priced? The interesting part here is that that's the most leading indicator on the pricing. We know that when there's multiple offers down the street, we have a new house to list, we know that we can price it a little more aggressively, or conversely, if the homes down the street have no offers and they're doing price cuts, then we know we list the new listings a little bit at a discount to make sure we don't have to price cut. And so that starts settling in. So that signal shows up in this light red line very soon. Last year, you could see last year where the median price was $370,000, the light red line was spiking up very quickly in January and February. That was the peak of the frenzy. And so buyers were buying everything. That was our bidding wars. And we could see that those were going, as soon as they would list, that those were getting offers. So the next one we listed a little bit higher. And so you can see that the light red line actually moved up above the dark red line in a steep curve. Then in April, it abruptly turned and started dropping, because that's when rates started kicking up in March and April. And so we could see that in the pricing for the year. So the price of the new listings right now is $375,000. Between the second and third week of January is an excellent time, because now we're mid-January, where we see who gets listed now. We've seen a few weeks of the post-holiday demand. And so there'll be a lot of signal in the new price of the new listings in the next couple of weeks. So stay tuned for what we might see there. On the other side of pricing is a leading indicator that I talk about all the time, and this is the percentage of homes on the market with price reductions. Right now, we have the fewest price cuts, and I have a typo in my slide, the fewest price cuts since July. 35.8% of the market has had a price cut. What's interesting to see here is each line in this chart is a year, and you can see there's a tight band. Most years, normal rates of price reductions is between 30-35% of the market. That is, some of those are strategic. We want to overprice and do one price cut before we sell. Some of them are accidental. A seller that wants to see if he can get his asking price and bids it really high. All of those factors, but about a third, 35% take a price cut. When the market's hot, significantly fewer do their price cut. So that seller who wanted to see if he would get his offer, got his offers, and he didn't have to do a price cut. And you can see there's a few things that you see here. One of the things, so since 30 or 35% is normal nationally, we are now at the left side of the chart here. You can see the dark red line, the first few weeks of January, and price reductions are declining. We get fresh inventory in January. They haven't done price cuts yet. We get buyers' demand starting to happen. If those homes are on the market now in March and April, that's when price cuts start to tick up again, because they came on the market, but now that you get that cycle starting to tick up. So what 35.8% is higher than it's been in a bunch of years. But that's obvious, right? We have less demand than we've had in a bunch of years. We have a big shift in the market from a year ago. But 35% is not crazy high. If it's over 40%, or if it's in January and it's climbing now, those would be signals of a market that is crashing, or one, two that like confirms our, everybody's worst fears that they're hearing in the headlines. But at 35% and falling pretty rapidly, like that actually is a signal that across the country, that sellers, they're decreasing the number of price reductions they have. They have fewer price reductions. Because they see the demand in the market. So that's an encouraging sign for prices to hold up this year, for transaction volume, that because we have demand in the market. One of the things you can see here, the light red line, the curve from last year, you can see last year at this time and through March was ultra low, record few homes need a price cut. Then in March, you see how it diverges from the little brown line from 2021. That was the first moment of the mortgage rate increases. And you could see it here first in March in the price reductions data. We could see in March, all of a sudden, wait, my buyers from February are gone. I need to do a price cut, and just a fraction more. And so you could see that it diverged, and we could already in March, and then definitely in April, you could see what was going to happen for the rest of the year. We're on the different curve right now. Price reductions are like falling pretty steeply, and it's something to pay attention to. Is the year going to be more like, is it going to have better transaction volume than anybody's expecting? You can see it here first. The other part you can see is in the light red line in September. So almost to the middle of the right side of the chart. In September, rates jumped from 5.5%, 6.5%, 7%. And you could see price reductions started spiking late in September, October, November. And so if rates this year start to drift over 7%, you're going to watch that price reductions to go right along with it. And that's when you'll want your sellers to be ahead of that curve, to be very sensitive to what's happening in the market. That 5.5%, 6% threshold, if rates are drifting higher towards 7%, make sure your buyers are prepared for that, because we can see, or your sellers are prepared, because we can see exactly what happened to buyer demand when that happened in the fall. All right. Let me do this. Let's look at price reductions at a local level. This is the Altos research system. If you're an Altos research subscriber, you have all your reports for your local markets. You have your contact database that gets all those reports every Monday. You have the email campaigns that you send them out to, and whether they're new buyers or longtime past clients who just want to understand how's the market, that's what the email campaigns do. And we now have this advanced analytics tab. Advanced analytics is a new product from Altos. It is now available for Altos subscribers at our premium level and higher, meaning you have at least a county of data to work with. I'm looking at the national data with my advanced analytics dashboard here. And what I like to do is I build a rank chart of the 50 highest metros, most price reductions. And you can see right now, Phoenix has the most price reductions at 53% of the market has had a price cut in Phoenix. You can see in the spark line here that you have 3 years of trend. And this is last year. Look, went from 19% all the way up at 63% of the homes on the market in the fall in Phoenix. 63% had to take a price cut. Now that's declining to 53, down to 53%. It's significantly better. Phoenix, like you remember, I told you the normal for the country price reduction is about 30 or 35%. Phoenix has more investors. They have more out-of-town buyers. They have a lot more new construction. And because of all those things, Phoenix tends to have price reductions more typically about 40%. So 40% would be normal. Last spring, it was 20. And before that, 16%. Normally, 40% need to take a price cut, but during the pandemic, people are buying everything in sight, so nobody had to take a price cut. Then all of a sudden, 63% of the homes took a price cut last year. So that's now curving back down. Boise was maybe the biggest, the poster child of the pandemic migration. So these are California people buying in Idaho. And you can see Boise went from 14% all the way up into the 60s last year before drifting back down. So it's, Austin is the other one. So you can see exactly where the biggest pandemic boom markets were, and they were adjusted down most dramatically here. And then the other side are the Central Florida markets also had these big steep rise in price reductions in the fall, but those are starting to tick back down now. And it's a really fascinating where that is concentrated. We'll come back and I'll dive in a little more into those local markets at the report level in just a second. But let's do a little bit more national data. Days on market is climbing quickly. Now it's 77 days across the country. Pre-pandemic is about 90 days, but you can see, during the pandemic, it was like 3 weeks on market, 5 weeks, and now we're getting back into a normal range. This time of year is a peak in price in days, and then as the spring kicks in, that starts falling again. So, but we're still climbing quickly right now, and we'll see. It'll be really fascinating where we top. If you'd asked me a month ago, I would expect it to keep climbing. But given some of those green shoots that we're kind of seeing with the buyer demand, we might see this might be the top of our days on market and have it start drifting back lower again soon. One way to look at the data, and what we do in all our Altos data and all our Altos reports, is we track the data in price range segments. So every zip code in the country, we look at 4 price range segments. The high end of the market may be behaving very differently from the low end. And this is a chart I actually generated in our advanced analytics product this morning. And I wanted to know at the national level, what is happening, the trend in days on market versus for the most expensive homes, those are the $1 million homes, versus the ones that are at the low end of the market, that's about 190. And what we can see, the black line here, the most expensive homes, last spring, they were both 3-4 weeks, almost no time on the market. Then starting in March, days on market started climbing at the high end of the market. We are now, 3 months on market. It hasn't gotten back to normal times, 120, 130 days. Those days would be influenced because there'd be homes that would be on the market for a couple of years. What's interesting, like the expensive stuff that sits around for a while before it sells. What's interesting, we sold all that during the pandemic. And so now that's just starting to build up. And so we haven't even gotten back there. There's a long way to go for the high-end properties to get back to their normal range of maybe taking 4, 5, 6 months on the market. The green line, on the other hand, is sort of back in its below its pre-pandemic area, right in about where it has been, showing that we have more demand at the lower price points, faster turnover. And you can watch that in any market. The low end of the market may be behaving very differently from the high end. And I'll show you that in just a second about how to look at that in an Altos report. Before we do that, I'd like to include rents. The median rent for single family homes in the US is $2,195 this week. That's about 5% higher than last year at this time. And you can see the chart, the red line there, the dark red line, peaked in the summer and then started drifting a little bit lower. Rents have ticked up for the last couple of weeks in a row. That's ticking up right alongside houses. And it's really fascinating. Sometimes we think about rents and home prices as they should be opposite. Like if we're not buying houses, people must be renting. And so rents must go up. But it turns out that doesn't happen. They move in tandem. If I'm moving out, I'm forming a household, and I might choose to rent or choose to buy, but I'm moving out and forming a household, and so they generally move in tandem as opposed to opposite each other. And what's interesting is that while rents came down pretty dramatically since early summer, they have ticked up the last couple of weeks, and it's something to keep an eye on. It's a message for investors. It's a message for buyers in their alternate. Like, it's not like rents are plummeting anymore. They plummeted. They came down pretty quickly during last summer, but as of right now, they're at this little motion. They ticked up the last couple of weeks. So it's something to keep in mind for your network. And in your Altos reports, There is a line in every zip code about on the houses tab, you'll see the rents for single family homes. On the condos tab, there's a rents for apartments. So you could do a comparison for them, for any of your buyers in any Altos report. As I mentioned, all of the data that we're talking about is available. It's available in Altos, and it's also, we describe it in the free ebook. So how to use market data in your business. It's got scripts, it's got ideas. Click through. Lael will put the link to that in the chat. So click through and download that if you don't already have it. But it can really help you use the conversation the same way I have done in this webinar so far. Let's do a few. Let's do a few local reports. Go over here. These are Altos reports. They're available for every zip code in the country. These are, I'm doing county and metro level ones for this conversation. These are branded for Altos, but for every subscriber, they're branded for you. So there's your report that we are automatically putting in your client's inbox every Monday, or however frequently you want to do it. Comes out every Monday. I included Loudoun County, Virginia today because I was talking with an agent friend of mine, Heather Elias, who is in Loudoun County. And she pointed out this week that Loudoun County has only 185 single family homes available on the market. And this is in the report here. This is, I've got inventory pulled up, 185 single family homes. There are nearly 500,000 people living in Loudoun County, and there's only 185 homes for sale. So your buyers may be hearing headlines of crashing housing market and home prices are falling and all of the big scary things. And they might be very surprised to know that in a county of 500,000 people, there's only 185 single family homes for sale. You could see last year in the pandemic, it's more than last year at this time, but 3 years ago, just pre-pandemic, 500 homes, significantly more homes for sale pre-pandemic. And most of the country has not gotten back to pre-pandemic inventory levels. So we're starting on the East Coast today, and then I'm going to move to some of the West Coast markets, and I'll show you what that means. And by the way, if I don't have time to get to your local market today, all you need to do is go to altosresearch.com. And when you sign up with Altos, the first thing we do is we set up your reports this afternoon for your local market. We walk you through how to read the data, and we set it up to get it into your client's hands starting immediately. So that's what we do. So if I don't get to your local market, we can do it. We just go to Altos and sign up, and you can get it. We'll do that process for you right then. I've got Charlotte pulled up. Charlotte was interesting to me today because if we look at Charlotte inventory, Charlotte is more than the last few years and almost back to its pre-pandemic normal. You can see this year inventory rose in Charlotte pretty dramatically from really low to pretty dramatically as things slow down with rising rates. We're at 3,200, last pre-pandemic might've been 4,000. So not quite to the pre-pandemic spot, but significantly more. And so it's a slightly different change, so that Charlotte had a lot of inbound migration from across the country, from New York in particular. And so that slows a little bit. But Charlotte did not change nearly as much as, say, Tampa. So the Central Florida markets slowed down significantly more. And we can look at a few things here. One thing I like to do is the market action index is an at-a-glance view to answer, how's the market? We can see that when supply increases or demand decreases, that speedometer starts to tick down towards the buyer's market side. And the right framing for you with your sellers is you go into your listing appointment with your market report. You say, while we have your house listed, I'm going to put this report in your inbox every Monday. And I want you to look at one number. I want you to watch this market action index. Right now, it's slight seller's advantage. We still don't have historically high inventory in Tampa, even though it's slowed way down. It's still pretty balanced. If this number falls while we have your house listed, especially as it gets close to 30 or under 30, that's the market giving us a signal that we have fewer buyers and more seller competition. If that's happening while we have your house listed, that may be the market telling us that we want to do a price change to get ahead of that curve. So I'm going to put this report in your inbox, and you keep your eye on this one number. That's what you use the market action index for. It's a really at a glance to understand what's happening. You can see the prices in Tampa had this really massive run up during the pandemic. Prices have since declined from last summer back down, but still haven't given up. The dots are each year over year. You can see last. So we're still not back to even last year's, even though prices have come down, they're still higher than they were a year ago in Tampa. If we look at Philadelphia, we can see Philadelphia is one of the examples, and I included it here because Philadelphia is, if we look at inventory, Philadelphia, much of the central, north, and east of the US is at the pandemic crisis low levels of inventory. So Philadelphia, whole Philadelphia market, you can see we're in low inventory range, same place we've been for years, and way fewer homes than were on the market in 2020. 13,000 versus 6, half of what we normally have, less than half of what we normally have. So inventory in much of the country, even though your clients have the thought in their mind that everything is tanking, they have the headlines in mind. Even though that's the case in places like Philly or Chicago or much of the Northeast, we still have pandemic crisis level lows of inventory. I'm going to show, I'll show Phoenix real quick because in fact, actually what I'm going to do is show Austin. So Phoenix, Austin, Boise, these were all these pandemic boom markets. And you can see Austin is very close to this balanced market of 30. Even Austin doesn't really have a lot of homes, but Austin is one place where we have more homes on the market now than we did pre-pandemic. And this last summer, inventory rose dramatically, and your buyers and sellers know it. They know that buyers in Austin now have significantly more opportunity than they did a year ago. But like the other part of the message here, inventory is falling right now and will fall for the next few weeks probably. And so there's no sign of a ton of inventory in Austin coming to market, but they do have more options than they have had in years. And so that's an opportunity for buyers that maybe have been sitting on the sidelines and worried. And the last one I'll show right now is San Francisco. These are condos in San Francisco. I brought it up today because, that message that the housing market is tanking and home prices have to tank is not true in most places. It is true in some places. And this is looking at condos in San Francisco. And we can see, and I pulled up price per square foot in the middle of my Altos report here. You can see that just pre-pandemic was right at its peak at almost $1,200 a square foot for those condos. During the pandemic, that came way down and has kept dropping this year, down closer to $1,000 a square foot for condos in San Francisco. And what's fascinating is like the world has this impression of like, this is what's happening everywhere in the country, but it's really only happening in a few select markets. And in San Francisco condos, these are work from home professionals in tech jobs. And it was the easiest ones to not live in a condo in San Francisco, like the easiest work from home transition, and it hasn't recovered yet. And so those are, there really are places in the country where we can see that change happen dramatically. But even in places like Austin and Phoenix, we could start to see the local buyers who are making offers. Like I think the investors are still holding back till they see more of the buyer activity. But like in Phoenix, for example, we had the iBuyers, we had all this other activity, which has yet to really resume. So the buyer activity we see now are like locals doing move up. I don't have to fight as hard for a home anymore. Those are really the trends that we've seen at local level. And as I mentioned, if I haven't had a chance to look at your local data today, just go to altosresearch.com. And when you sign up, the first thing we're going to do is look at your data for your clients talk about how to understand and explain to them what is happening in your market right now. That's all the time we have for today. We will stick around for a second in the chat. If there's anything left to do, make sure you get the ebook. Visit us at Altos and book time with our team. Make sure you sign up for the YouTube channel as well. And Ginny, I will let you come back on too if there's anything else you want to share with your audience.
Yeah, so I just your weekly report is just awesome. Of course, it's nationally, but like you showed today, you can derive what's happening nationally down to your market to some degree. So follow Mike on YouTube and Twitter. I look at his Twitter mostly and just see what he's saying with it. But do both, and we really appreciate you coming today. And we will be sending out the recording to you as soon as we get it. So I know you took notes, but this is all great stuff. I was definitely taking notes. I see balanced market. So that's good for everyone.
Yeah.
All right, Mike, thank you again.
All right, thanks, Jenny.
You're awesome. Appreciate you. Bye-bye.